Good morning, everyone, and thank you very much for joining me. This is the morning market review. My name is Russell Shaw. I am a senior market specialist at FXCM, and today is the 14th of February. Just going to go ahead, bring up our disclaimers before we get on with the live stream. And here we're going to start off with a high risk investment warning. I'll keep this on screen for a few moments. If you guys can just take a read through that, be much appreciated. All right, and here is our market commentaries disclaimer. All right, excellent. Let's go ahead and bring up the real rate. All right, so we're looking at the US 10-year real rate, and the obvious candlestick to look at is yesterday's candlestick, and you can see that it has pushed up remarkably. Very long blue candlestick there, a long ranged candlestick. A lot of, let's call it emotion, pushing the yield of the real yield up, and it jumped close to 5% yesterday. We got 4.5% jump up here, and that was all because of the inflation rate. Okay, so the CPI numbers came out yesterday, and they certainly surprised me. I thought there'd be more obvious moderation there, and there wasn't. It was inherently sticky. So we saw the sticky inflation, and that is worrying. You know, it's kind of the question: has the low-hanging fruit all been picked? And now, can we get the inflation down to 2%, which is the Federal Reserve's target, relatively smoothly? And yesterday, well, there was a hiccup, right, because of the stickiness. And the idea here is that the Federal Reserve is going to be very wary. There is almost a break between what's happening with CPI and PCE. They seem to be showing slightly different things, with the CPI showing much more, let's call it stickiness. The PCE is the Fed's preferred gauge of inflation. Nevertheless, there's some sort of divergence there. And I think the Fed is going to be wary, to the point that we have seen hey, KD, good morning to you. Welcome. So we have seen now the March rate cut has been priced out of the market. So we're not going to get a rate cut in March. What about May? Well, yesterday we looked at May's probability, or we suggested it at 48%. It was pretty close to 50%. I looked at it this morning. It's 38%. So we've lost 10 percentage points there. Okay, so it now looks as if May is starting to get pushed back as well. And that is bad news for the risk markets. Why is it bad news for the risk market? It's because the rate cuts have been priced into the market. What if the rate cuts are going to be pushed back? Then there has to be a repricing in the markets, because they have effectively priced them in. Hey, Raj, good morning to you. Does everybody understand that? So the fact that we've had March being priced out, now we're getting May being priced out, and that is bad news because it's been inherently priced into the market. So let's take a look at some of the data. Let's actually start off with the CPI and the core CPI. Let's see if there's anything we can glean off of that. So let's go ahead and bring that up. Bear with me. I'm going to bring up, let's bring up headline inflation first. All right. I'm going to share this with you in a moment. Here we go. All right, let's move this. Yeah. Hey, Kim, good morning to you. Welcome. All right, what have we got here? So you can see we've got this. Is this? Oh, it hasn't even been priced in. It should be coming down. This is a bit of a lagging chart. That's weird. It should be at 3.1%, not 3.4%. 3.4% is the month, so we should be. That's odd. Let's see if we can find it. So that's not going to help us. Let's take a look at the core. No, hasn't priced it in. All right. Well, let's not waste our time with that. Let's take a look and see what's happening on the. Let's go see what's happening on the risk markets, and we'll take a look at how the SPX 500 effectively reacted off of the. Good morning, Bubba Free. All right, let's take a look at what's happening with S&P 500. All right, guys, so this is the S&P 500. It's the weekly chart. It's the weekly chart. Now, something that I think is quite nerve-wracking, something which I think is quite scary, is despite the fact that we had quite a severe sell down yesterday, so if we look at it on the daily chart, right, if we take a look on the daily chart, you can see yesterday there is a sell down right here. Okay, to the point that the overbought condition, so we had an overbought condition on the daily chart, that's now normalized. Okay, so that normalization in the RSI should give us some sort of comfort, except when we take a look at the weekly chart. If we go through to the weekly chart, we haven't quite cleared this overbought condition. And because we haven't cleared this overbought condition, we can introduce some sort of hypothesis here. And the hypothesis is as follows. Okay, the hypothesis is as follows. Given the fact that the stock markets have priced in a May rate cut, and that May rate cut is now starting to be priced out. Remember, the probabilities now are around about 38%. In fact, I saw it at 38.1%. Okay, so we've got a 38% chance of a rate cut, and effectively, if that continues to be priced out of the market, it makes sense why we still overbought here, because eventually this will normalize downwards as the repricing happens. So I'm a little bit nervous given the fact that the weekly chart hasn't normalized. So we're going to have to watch that. Now, typically, there's two ways for a overbought chart to normalize, aren't there? There's number one, a pullback. So if we get a pullback and it moves as so, okay, then we get the normalization in the RSI. Okay, so that's the one way. The other way, and that would be moving back towards the EMA. Okay, so that's the one way of doing it. The other way, the second way, would be that we just kind of start drifting here, and the EMA catches up to price, and that would get rid of some of that froth. It's a hey Anna. Okay, so either, let's just see, there's either going to be, I don't know which one is, but I think over time there has to be a normalization in the RSI. Now, we're looking at a weekly chart here. It's inherently difficult to time a normalization of a weekly overbought condition. Just take a look. Let's see if we can find other overbought conditions. Obviously, there's one over here. All right, let's get the camera out of the way so we can kind of see. All right, so let me just show you. We've got this overbought condition. I'm going back now to what are we here? June 2023, and it takes a number of weeks before that overbought condition normalizes, and as it takes a number of weeks, we still get some sort of movement up here. So what I'm trying to say is that it's inherently difficult for the weekly chart to be used in a timing type of discussion. It's much the lower the time frame, the easier it is to use overbought, oversold conditions for timing, right? That's why when we take a look at the daily chart and the fact that the daily chart has normalized, well, we kind of expected that. There was an overbought condition here, then we had a normalization. There was an overbought condition here, there was a normalization. So now Anna's asked a really good question. Is the sudden drop in the RSI on the daily a cause for concern? So I'll tell you where it's going to get. So my answer to that, Anna, is not yet. So where it's going to get concerning, is when it drops below 50. Okay, so if the daily RSI drops below 50 and we're starting to see the weekly chart unfold in sort of a normalization of that RSI, I think that's the way that we should look at it. But I still am of the opinion, okay, and I must tag on here subject to correction, because I don't know. The markets, we don't want to predict, we want to react. I'm still of the opinion that we are in a bull market. And I think that when the weekly chart normalizes, I think it's going to give us opportunity. The problem is if we're holding now, then of course we're going to have to take the sort of the gut punch, right? The punch to the gut as it pulls back. So that's something that we're just going to have to acknowledge. Let's just talk about this in a little bit more detail. Okay, I'm just going to pull the chart way to the left, and I just want to talk about how a bull market unfolds. Okay, let's just talk about how now we've typically seen this before, but let's show it again. According to Dow theory, a bull market unfolds over 3 stages. Okay, it unfolds over 3 stages. I'm going to just change this actually to a weekly. Okay, that's fine. Let's just put it all the way to the left. All right. Let's just see the comment here. So drift with the RSI above 50 would confirm the bullish stance. Yes, but let's just be careful here, because we've got to differentiate between primary trend and secondary reactions. I don't think, Anna, so listen, let's just say that the daily does drop below 50. Let's just say, and I think there is a real possibility of that happening. Does that mean that we've lost the bull market? And I would suggest that it does not suggest that we've lost the bull market, because the higher time frame, as long as we're over 50 on the higher time frame, the primary bull market maintains. Does that make sense? Okay, just let me know. So I think we could lose it on the daily, but I don't think we can lose it on the weekly, subject to correction. Okay. That 5,000 price point significant. We've said that 5,000 price point significant, Katie. We said that 5,000 price point is a psychological resistance area. And not only is it a psychological resistance area, it's a psychological resistance area when we've gone overbought. Do you know? So there's kind of like a double hit there. It's like bang, bang, Let's just take a look at how the bull market unfolds. Let's take a look at how bull market unfolds, and let's try and be it's very hard to be objective. But I'm saying let's try and be as objective as possible. I don't know if I'm being objective or subjective here, because of course, once your emotions are involved, it kind of blinds you to objectivity. But the idea here is, let's just take a look at how a bull market unfolds and see if we can use that insight to help us out. So typically what happens is we have stage one. Stage one is quite flat. It's after a bear market. Okay. Then what happens is we go into stage two. So let's just talk about, and stage two tends to be the longest and the safest. Okay, let's get rid of the camera here. I understand it's covering. All right, so you should be able. So now let's just put in some labels. Okay, let's just go through some labels. Yeah, we'll take a look at the Nasdaq in a moment, but let's just go through this this model of how a bull market unfolds. So you've got here what we call the renewed confidence. So in other words, it's just after a bear market. Nobody really understands that the bull market has begun, except for the smart money, the professional guys. They realize that the market is not going to go much lower. Let's just change this to black. So we've got this renewed confidence stage. Now, the second stage, which is the longest stage and the safest stage, does anybody remember what that is? That's called improved earnings. And our earnings have been really good this season. And not only that, we're getting some really good forward guidance as well. So we're getting kind of this improved earnings. And then what's the third stage? What can you guys remember the third stage? The third stage is the most dangerous. Cheers, Raj. Cheers, Raj. The third stage is the most dangerous, but it's also where the most money gets made. It kind of moves up, like it skyrockets like that. So you've got like these gradients that goes flat, steeper, and then steepest. And the third stage being the most dangerous, that's what we call rampant speculation. I don't see rampant speculation. I think when we start seeing rampant speculation, have I spelled that right? Speculation. That's when we get really, really risky, Anna. You know, for the change of the bull market, I think we need to see a rampant speculative stage, and I just don't see it. There are hints of it. I guess, like if you take a look, so I took a look at Nvidia yesterday. So Nvidia's jumped 50% just this year alone. I mean, we're only on the 14th of February, and the stocks jumped 50%. But I think there's still a lot of demand that is driving Nvidia stock. So I think there is a fundamental case to be made for Nvidia, and I did read that there was a price. One of the analysts on Wall Street changed his price target from, I think it was $750 to about $920 or something thereon. So yes, so maybe the movement of 50% in less than 2 months. There's speculation there, but I don't see it widespread, and I still think there are some underlying fundamentals there. But the idea here is, I think we're getting like really good earnings at the moment, and these earnings, I think, are really supporting the stock market. It's that numerator, right, on the time value of money. And yes, there is now a pushback in the. There's now a pushback in the. There's a pushback in the expectations of rate cuts. That's a risk. But I think the rate cuts are going to come. It's not like they're not going to come. It's just that we higher for longer for now. And I think there has to be some sort of repricing there. But I think that by and large, the stock market fundamentals are good with their own with the earnings. Nvidia doesn't have their own labs. Yeah, but their product is in demand, so they don't have their own labs. I'm not sure if that has a huge fundamental impact. I mean, their chip is high. They can't keep up with the demand. They can't keep up with the demand. Okay. What do I think with the geopolitical risk? Well, I think there's geopolitics. I think the geopolitics are, Anna. I think it's a tough question. There's geopolitics. The geopolitics are in Ukraine, Middle East, Taiwan Strait. Yeah, they pose a risk. There's no doubt about it. So what if Taiwan is invaded? Jeez, let me just say, I hope, I pray that doesn't happen. I think if it happens, then of course it introduces huge risk. Of course, gee, you know, I don't know. Look, there was an aid package. What I can say, there was an aid package that was approved by Congress with a ton, like billions of dollars, going through to Ukraine, Israel, and Taiwan. So maybe that's some sort of deterrent. We'll have to see. All right. So the thing is, has there been some sort of pricing in of an invasion in Taiwan? I don't think so. I don't think the market's anticipating that. Okay. All right. Let's take a look at NASDAQ. Okay. So I think, subject to correction, guys, because of course markets change and it's very difficult to come out with a succinct, spot-on analysis, but I think we're in improved earnings. And I think that we will eventually get into rampant speculation. And I think when we get into rampant speculation, I think it's going to be obvious. And I think you and I will have the conversation where the rampant speculative stage is just kind of blindingly obvious, which I don't feel that's the case now. Let's take a look at NASDAQ. All right, so I'm going to just I'm going to bring the camera to the right side of the screen. And what I'm going to do is I'm going to bring up NAS 100 here on the weekly. I think that the AR story has still got somewhat to run. I think, Anna. So, but I think it eventually catches up with us and we get into that speculative stage. I beg your pardon. All right. Here is the NASDAQ. Here's the NASDAQ. It's not as overbought as the S&P 500. I found that quite strange, to be honest. But lo and behold, this is the weekly chart of the NASDAQ. We're not overbought. It's the S&P 500 which is overbought, but the idea here is, of course, that the markets, I think the markets will tend to move in quite a tight correlation, right? Positive correlation. So let's just let's ask some basic questions here, Katie. Where is NASDAQ relative to its black 30-week exponential moving average? And it's above it. Which direction is that 30-week exponential moving average? It's pointing in the northeast. We are tending towards overbought, so we've got to be very, very careful. We've got to be very, very careful. There is no doubt that as the real rate pushes up, so I'm just going to show you the real rate again. As the real rate pushes up, that's going to have an effect on NASDAQ. NASDAQ theoretically has the greatest sensitivity to interest rate movements. If the interest rate movement goes up, KD, we should get a headwind, a pressure on NASDAQ. Okay, let's go through to the daily chart of NASDAQ, see what it is that we can see here. I just want to show NASDAQ in the comes. All right, let's just zoom in here because all right, so where are we with the zones? we've dropped from zone 1 to zone 2. So there's no doubt, Katie, there's been a movement backwards on a relative basis, right? It's moving backwards. But then if you take a look what we drew yesterday, the question is, are we going to get this dip in the uptrend? And if we're going to get the dip in the uptrend, we can look at the hourly chart for some sort of timing mechanism. Just bear in mind, I'm very cognizant of the fact that the CPI data is quite raw. We are getting this repricing taking place, and we don't want to be caught on the wrong side of that. Let's just go down to the hourly and see what is happening on the hourly. See if there is a dip in the uptrend. Let's just see if that's what's potentially taking place. So going down to the hourly here, and I'm just going to bring up NASDAQ. And this is where we'll end off, guys. We'll just take a look at the NASDAQ 1 hourly, and it's very interesting. It's very, very interesting, because it does look as if we may be getting that dip in the uptrend that we spoke about yesterday. We may be getting it. Why do I say that? We've got trigger 1. Here's trigger 1, right? We've got the 5 hour. We've got the 5 hour. We'll go back to the bands in a moment. Let's just understand that the 5 hour exponential moving average is crossing above the orange 10 hour, and we're getting that expansion in the EMAs. What's happening with the stochastic? The stochastic has crossed positively, and it's heading towards the upper quintile. If it gets into that upper quintile and holds, then we've got that proverbial dip in the uptrend. But just make sure we're in a high risk environment, given that there's been a repricing here. Make sure that everyone has risk management, and that includes money management, that includes stop losses. All right, Anna's just pointing out to the Bollingers. So we just go to NASDAQ. So I think what we're going to do here, Anna, is obviously keep an eye on what's happening. I think the step from zone 1 to zone 2 is most obvious. I can see the tightening that you're talking about. Let's keep an eye on it. But I think that it looks to be, if there is getting some sort of dip in the uptrend here, be very careful. Be very, very careful. The interest rates are being priced out of the market until second half. Okay, and I think that's extremely pertinent, because the market has been risk on predominantly. Why has it been risk on predominantly of late? Is because one of the reasons is because we have been expecting price cuts earlier. That doesn't seem to be the case now. It looks as if we're going to have them later. Let's stop right here, guys. Any questions, please go ahead and type those in. Any questions, go ahead and type those in. I will request, if you found this useful, to go ahead and click on that rocket ship button, that boost button. It just helps me sort of disseminating these live streams, but only do it if you found it useful. Okay. I don't see any comments coming in. Let us wrap up here, and we shall do it all again tomorrow. I want to wish everyone a great day, great evening ahead. We'll catch up tomorrow, same time. Thanks very much, guys.